Welcome to the Deep Dive.
Glad to be here.
Today we're digging into the Financial Institutions Global Asset Management Report 2025.
That's right, a pretty hefty report.
Yeah, definitely. Think of this as like your fast track to understanding the really big shifts happening in, how the world manages its money. Our mission really is to pull out those crucial insights, give you a clear picture of where this huge, $128 trillion industry is actually going.
Exactly. We've gone through it, sort of sifted out the key trends, the challenges. It's not just the headline numbers, right?
Right.
It's about understanding the forces moving underneath.
And speaking of massive numbers,
Hmm?
you mentioned the headline. Did you catch this?
Yeah.
2024 global assets under management hit a record $128 trillion.
Wow.
It's a staggering 12% jump just from the year before. So first glance, you'd think, okay, everything's booming.
Yeah, that's definitely the big shiny number, and it shows a strong rebound for sure. Okay, yeah, there's a but. While that growth looks great, the report shows it's not all coming from the same place.
Okay.
And that really matters for what comes next.
Right. Because when you dig a bit deeper, that 12%, it kind of hides some really interesting stuff going on. The report talks about these fundamental shifts in what investors are actually buying, more competition,
Yeah.
and this growing pressure for asset managers to, tighten their belts.
And what's fascinating is where that 2024 growth actually came from.
Yeah.
The report suggests something like 70%. That was just market performance.
Ah, right. Like the S&P 500,
Doing well.
the NASDAQ.
Exactly. Those big runs they had. Only about 30% was actual new money coming in from investors.
Okay, so that immediately makes you think, how sustainable is that growth if it's mostly just the market going up?
Precisely.
Yeah.
Especially with, global economics always being a bit shaky. U.S. tariffs, other things.
So rising tide lifted the boats, but what happens when the tide goes out? And it sounds like even the new money, the 30%, it wasn't as profitable as the old money.
That's exactly it. Half of the revenue increase they saw got wiped out by two things.
Okay.
One, investors choosing cheaper products. And two, the average fees managers could charge. They're getting squeezed down.
How much squeezed?
Well, think about it like this. The fees on those new inflows in 2024, they were about 40 basis points lower than the fees on the assets they already had from 2023.
Ouch. That's a pretty big hit to the margins.
It really is a significant squeeze.
Which kind of leads us nicely into that trend we hear so much about,
Hmm.
active versus passive.
Yes. The big shift.
The report must have some numbers on that.
Oh, it does, and they're quite telling. So the share of assets in actively managed mutual funds and ETFs, it dropped from 65% in 2023 down to 61% in 2024.
61. Okay.
And globally, active funds, if you exclude money markets, actually saw outflows. A net negative 0.1 trillion.
Wow, negative.
Yeah. Meanwhile, passive funds, they pulled in a massive $1.6 trillion globally.
1.6 trillion. That just shows the power of that move towards, lower fee index tracking.
It's a really powerful force reshaping things, absolutely.
But you mentioned globally. Was it the same everywhere? Or did some regions buck the trend?
Good question. No, it wasn't uniform at all. There were some pretty notable differences.
Like where?
North America, for instance. That's where the really big outflows from active funds happened. About $337 billion out.
Okay, so North America dragged the global number down.
Pretty much, yeah. Enough to make the whole global net flow for active negative. But interestingly, every other region, they saw positive inflows into active.
Really? Where were those inflows going?
Particularly into fixed income active strategies and also actively managed ETFs.
Active ETFs again. We'll come back to those.
Definitely. But it shows, demand for active isn't totally dead. It's just changing shape, changing location.
So even within active, things are getting shuffled around. Now, here's something interesting. Despite all this fee pressure, the shift to passive, the report says profits for asset managers actually went up in 2024.
That's right. Seems counterintuitive, maybe.
How did it happen?
Well, even with those lower fees on the new money, the sheer volume, the overall growth in assets and revenue, it still managed to grow faster than their costs did.
Okay. So revenue growth beat cost growth.
For 2024, yes. Led to about a 22% rise in profits overall. But, and this is a big but,
Hmm.
it's really crucial to see this might not be a long-term thing if those fee pressures keep up and growth stays so reliant on just the market going up.
Right. It could just be a temporary blip.
Could be, yeah.
Okay, so we've got growth, higher profits for now, but these big shifts bubbling under the surface. What are the key opportunities the report sees for managers to actually thrive in this new world?
It really flags two major avenues. First, carving out a really strong position in the active management areas that are still attracting money, specifically things like active ETFs, model portfolios, separately managed accounts.
Right, the areas you mentioned seeing inflows outside North America.
Exactly. And the second big one, playing a key role in getting private assets, private equity, private debt into the hands of retail clients, regular investors.
Okay, let's unpack that first one. Active ETFs. We all know passive ETFs exploded.
Mhm.
Why are active ETFs suddenly gaining so much ground?
Well, for years, like you said, investors went for passive ETFs. Why? Lower costs, often better returns after you account for fees.
Liquidity, tax efficiency in the U.S.
Right, transparency,
Yeah.
all that compared to the old active mutual funds. And that passive ETF market, it's pretty mature now, very concentrated. The top 10 players control something like 82% of the assets.
Dominated.
Totally. But now we're seeing this second wave growth in actively managed ETFs. It's been huge, like a 39% compound annual growth rate over the last decade.
39% CAGR.
Yeah, it's taking off.
And the report mentioned something about performance versus fees. That active ETFs aren't necessarily better at beating the market than active mutual funds, but the fees.
That's the key point. There's no structural difference found in their potential to beat the market. But the average fee, an active ETF is around 0.64%. An active mutual fund, more like 1.08%.
Big difference.
Huge. So you get the potential upside, but at a significantly lower cost. That's a really attractive proposition for investors.
Makes sense.
Plus, the market for active ETFs, even though it's growing super fast, like 44% of all ETF launches in 2024 were active.
44%.
Yeah, but still pretty new overall, only about 7% of total ETF assets. And it's much less concentrated than passive. The top 10 only have about 65%.
So more room for players to come in and grab market share.
Exactly. Creates
Tough time.
opportunities.
So for an asset manager thinking about this, it seems obvious. Just launch some active ETFs, right? Easy peasy.
Ah, if only. It's a bit more complicated. Firms face some tough choices. Like, say you already have a bunch of successful active mutual funds. Do you convert them into ETFs? Or launch totally new ETF versions?
I see the dilemma. Conversion might cannibalize your existing, maybe higher fee mutual fund business.
Exactly. That's a real risk. And either way, you need to build new muscles, new capabilities.
What's that, Jeff?
Things like product specialists who really understand ETFs, different marketing approaches. The legal side is different. You need capital markets teams. It's a whole new skill set for many.
That sounds like a pretty heavy lift. Building all that from scratch. Are there shortcuts, ways to get in faster?
Yeah, the report mentions the rise of what they call ETF accelerators or white label providers.
Okay, what do they do?
Basically, they're specialist firms. They help asset managers launch ETFs quicker with lower upfront investment because they handle a lot of the tricky stuff, the structure, the regulatory filings, dealing with the market makers.
Like outsourcing the plumbing.
Sort of, yeah. But there's a trade-off, of course.
Always is.
You usually give up some control over the operations, and you have to share some of the revenue with the provider.
Right, makes sense. Okay, let's switch gears to that second big opportunity. Private assets for the retail market. This feels like a big shift. Usually private equity, that stuff is for institutions, right? Or the super rich?
Traditionally, yes. But there's definitely a growing appetite among, let's say, more regular affluent investors. They're looking for those potentially higher risk-adjusted returns that private markets might offer.
And the private market managers want their money too.
Oh, absolutely. They see this huge pool of retail capital. It's like 48% of global assets, and they want to tap into it.
And these alternative investments, they're pretty lucrative for the managers already, aren't they?
Hugely. Get this. Alternatives, which include private assets, bring in over half of the entire industry's global revenues.
Wow.
But they only manage less than a quarter of the total assets.
That shows you the fee potential.
Definitely. And growth in things like private equity, private debt, real estate, infrastructure, it's been growing way faster, like 11.1% a year since 2014 compared to about 6.5% for everything else.
Okay, so the demand is there, the supply wants to meet it, but the report mentioned hurdles. big ones.
Yeah, significant hurdles. First, the products themselves. Private assets aren't like stocks you can sell tomorrow. They're illiquid.
Right. Lockup periods and stuff.
Exactly. And the regulations are different, often more complex. Then there's the distribution side.
Educating people.
Yeah, educating not just the investors, but their financial advisors, too, about how these things work, the risks involved, plus just the logistics, onboarding tons of smaller investors, doing all the compliance checks like KYC, AML.
Know your customer, anti-money laundering.
Eh,
Yeah. That must be harder for smaller investment amounts.
It presents different challenges, for sure. You need scalable processes.
So how are firms trying to solve this puzzle right now? What are the approaches?
Well, the report mentions a couple of things that are emerging. One is using tech-enabled feeder funds.
Feeder funds.
Yeah, they pool money from lots of smaller investors into one vehicle, but they often still have liquidity issues for the end investor. You might be stuck until the fund matures, and they can be complex for advisors to manage.
Okay. What else?
The other big area is the growth of evergreen semi-liquid funds.
Evergreen semi-liquid. Sounds fancy.
Yeah. Basically, they can continuously take in new money, and they offer investors chances to redeem their money periodically, maybe quarterly or semi-annually.
So a bit more flexibility.
A bit more, yeah. These have grown a lot, over $300 billion in assets in 2024. But they require the manager to be really good at managing the underlying assets' liquidity, maybe holding some cash or having credit lines ready.
Right, so they can meet those redemptions. It sounds like we're still figuring out the best structure. What about the future? What does the report see coming down the pike?
Lots of innovation expected. We might see private assets bundled into active ETFs somehow.
Interesting.
Or put into model portfolios alongside public stocks and bonds. Maybe entirely new hybrid vehicles mixing public and private.
And technology. Blockchain. Crypto.
Yeah, the report definitely sees a role there. Things like tokenization, turning a piece of a private asset into a digital token.
Yeah.
That could, in theory, lower the minimum investment needed, make trading easier, maybe increase transparency. Still early days, but potential there.
And you also see M&A focused on this.
Absolutely. Lots of mergers, acquisitions, partnerships specifically designed to get private market expertise or distribution channels.
Okay, this really paints a picture of an industry in flux, which brings us neatly to the next big force the report talks about. Consolidation. Mergers and acquisitions across the board. Why is everyone trying to get bigger?
Well, it really boils down to chasing scale and scope.
Scale and scope.
Yeah. The average asset manager actually doubled their assets under management between 2013 and 2023. Partly organic growth, partly M&A.
And scale means lower costs.
Generally, yes. The report shows that firms below about $300 billion in assets see pretty significant cost savings as a percentage of their assets as they grow.
But it's not always linear.
Interestingly, no. There seems to be this tricky phase, maybe between $300 and $500 billion AOM, where complexity actually increases costs, temporarily diseconomies of scale.
Growing pains.
Kind of, but then above $500 billion, the scale benefits seem to kick back in, and firms can optimize better.
And what about scope? What does having broader capabilities bring?
It's about offering more things to more people in more places. Diversifies your revenue, lets you maybe share costs internally, like one tech platform for multiple products, and just gives you a better, more complete offering for clients.
Makes sense. The report actually lists 5 key reasons or objectives behind all this M&A and partnership activity. What are they aiming for?
Yeah, the 5 main goals seem to be: 1, broaden their alternative investment offerings like we just discussed with private assets.
Okay.
2, expand globally, especially into faster-growing emerging markets. 3, build up tech and data skills, often by buying fintechs or AI companies.
All right.
4, secure more permanent or sticky capital, think tying up with insurance companies. And 5, get closer to the end client, maybe via wealth platforms or direct-to-consumer channels.
So it's not just about getting big. It's about getting the right kind of big, filling specific gaps.
Exactly. Strategic expansion.
But picking the right deals is one thing. Making it actually work, that's another story, right? The report stresses execution.
Oh, absolutely. Execution is everything. If it's a merger, the post-merger integration, the PMI, that's critical.
Getting the teams, the systems, the cultures to match.
Precisely. Leadership alignment, operations, culture. And keeping investors informed and confident throughout is vital. And if it's a partnership, you need super clear agreements up front.
Like who does what?
Yeah. Who's responsible for distribution, product development, how you go to market together, making sure you're aligned on regulations. All that needs to be hammered out.
Yeah, you mentioned insurers. We've seen quite a few deals between asset managers and insurance companies, especially around private markets.
Yeah.
What's the synergy there?
It's often a really good fit. Insurers have huge amounts of long-term money.
Right, from premiums.
Exactly. And that fits well with the long-term illiquid nature of many private assets. Insurers want the potentially higher returns, something like 91% plan to invest more in private assets.
51%.
Yeah. And for the asset manager, they get access to this massive, stable, long-term capital base. That's gold dust, especially for building out private market strategies, which can require big, complex deals.
So it helps them scale up those lucrative private market businesses.
Exactly. And it also positions both sides well for the growing retirement market, annuities, income products, that sort of thing. Of course, navigating the regulations and capital rules for insurers is key.
Makes sense. Okay, so we have growth, but shifting products. We have consolidation driven by scale and scope. The third big theme, the third force, is this need for asset managers to become, what did the report call it? Radically leaner.
Radically leaner.
Why is it strong language? Why is cost cutting so urgent now?
Well, costs across the industry have been climbing pretty steadily, like a 6% compound growth rate just from 2022 to 2024.
6% a year. Okay.
At the same time, like we said, fees are under constant pressure.
Okay.
So simple math. If your costs keep rising and your revenue per asset keeps falling.
You've got a problem. Profitability gets squeezed.
Exactly. So
Yeah.
getting costs under control isn't just nice to have anymore. It's fundamental. It's strategic.
And where are the biggest costs?
The report points to IM&TE, investment management, and trading execution. That's often 30–40% of the total cost base.
Driven by paying top dollar for portfolio managers and traders.
Largely, yes. Intense competition for talent, especially, again, in those specialized high-growth areas like private markets.
And the report revisits this idea of a trifurcation of cost structures based on strategy. I think that came up a few years ago.
That's right. It's the idea that firms are increasingly falling into one of three main strategic models, and their cost structures reflect that.
Okay, refresh my memory. What are the three?
So first you have the alpha shops. Their whole game is generating alpha, superior returns, through active management. So they spend big on investment talent and trading tech, maybe around 39% of costs there. They might even outsource distribution.
Got it. Alpha shops. Number two.
Beta factories. These guys are all about low-cost passive products. Efficiency and scale are key. So they focus on minimizing operating costs and making smart, strategic IT investments, maybe 22% of costs on IT for automation and scalability. Some might even become tech providers themselves.
Beta factories. Makes sense. And the third.
Distribution powerhouses and solution providers. Their strength is client relationships and offering tailored solutions. So they invest heavily in sales, marketing, client service, operations, perhaps around 39% of costs in those areas. They need to be really close to advisors and end clients.
Okay. Alpha, beta, distribution. Three different models, three different spending patterns. But the report says, regardless of your model, everyone needs this zero-based mindset for costs now. What's that mean in practice?
It means you don't just tweak last year's budget, you question every expense from the ground up. Assume it's zero unless you can justify it.
Okay. And how do you actually do that?
The report highlights three main levers. One, outsourcing. Be really honest about what's core and what's not. Non-core, expensive stuff like back office processing. Outsource it. Smaller firms might even outsource more tech and data functions now.
While bigger firms might invest in their own tech.
Potentially, yeah, if they have the scale. Second lever, automation, especially with things like Gen AI.
Generative AI, how's that helping?
Improving efficiency all over the place. Research, summarizing reports, helping with trading analysis, drafting client communications, compliance checks.
Lots of potential.
Huge potential,
Yeah.
especially for diversified firms that can use customer data across different parts of their business. Partnering with AI specialists is also an option.
Okay. Outsourcing automation. What's the third lever?
Avoiding dual run costs. This happens when firms expand, maybe into a new asset class. Instead of hiring a whole new team immediately, can you leverage your existing experts across both the old and new areas, at least initially? Be smarter about resource deployment.
Right. Don't pay for the same capability twice if you don't have to.
Yeah,
And AI, it sounds like it's moving beyond just experiments now.
definitely. The report has a whole section on AI evolution. The shift is clear from just playing around with it to really integrating it into core processes.
Across the board. Front, middle, back office.
Yep. Client engagement, investment management support, compliance monitoring, operations, IT, it's becoming embedded. And the early movers, they're reporting real efficiency gains, real cost savings.
But it's not all smooth sailing. There are still challenges.
Oh, for sure. Integrating AI with legacy systems, ensuring the models are reliable and fair, setting up proper governance, dealing with new regulations like the EU AI Act. Plenty of hurdles still.
So the focus now is on refining how it's used and expanding those AI-driven strategies.
Exactly. It's becoming table stakes.
The report also had some appendices, right, with regional growth figures and product breakdowns. Anything jump out at you there?
Yeah, a couple quick things. On regional growth, basically everywhere saw positive AUM growth in 2024. North America still dominates in terms of sheer size, though.
Okay. And by product.
The appendix really reinforces that point about alternatives. Way over 50% of global revenues, but less than 25% of the assets. Shows you where the money's made. Passive and traditional active core still hold the bulk of the assets, though.
And looking forward, say, to 2029.
The projections basically show ETFs, both passive and active, and certain alternative products continuing to lead the growth charge in terms of attracting new assets.
Okay. So let's try and wrap this all up. It really feels like the asset management industry is at this, I don't know, inflection point maybe, record growth on the surface.
Yeah, record AUM.
But underneath, you've got these huge shifts, investor preferences changing fast, competition heating up, and this really urgent need to get costs down, get more efficient.
That sums it up pretty well. And those opportunities in active ETFs and bringing private assets to retail, they look like the big growth frontiers right now.
Alongside continued consolidation.
Yep. Expect more M&A as firms chase that scale and scope we talked about.
And technology, especially AI, isn't just a sideshow anymore. It's central to managing costs and staying competitive.
Absolutely critical. A strategic approach to costs, leveraging tech smartly. That's going to be key for winning in the years ahead.
This has been, wow, a really comprehensive look at the forces reshaping asset management. Thanks for breaking it down.
My pleasure. Lots happening.
It definitely leaves you thinking, considering all these deep shifts we've talked about, what fundamental assumptions about how asset management has always worked might need to be, I don't know, challenged or thrown out in the next few years?
That's a big question.
And maybe for you listening, how do you navigate this if you're an investor? How do you make sense of this increasingly complex landscape?
Definitely food for thought.
Yeah. Gives you a lot to mull over. Thank you again for joining us for this deep dive. Really hope this helps you think about the implications of these trends, maybe for your own strategies, and encourages you to dig deeper into anything that particularly caught your interest today.